This is Impact Healthcare, people and strategies that are disrupting the health benefits industry. And now, here's your host, healthcare benefits industry expert and the originator of the transparent health benefits movement, Lester Morales.
Welcome back to another episode of the Impact Healthcare podcast. And, normally I say I'm kind of one of the dorkier persons on this call. I might be out-dorked on this call with the knowledge base that this guest is going to bring us. Phil, for those of you that the audience that doesn't know you or your great company, give us an introduction.
Thanks, Lester. So, Phil Holowka, I am the COO of Complete Captive Management Services. And to keep it really simple, we are a captive insurance manager, and our flagship is a medical stop loss captive insurance company.
Awesome. So, Phil, I often see that people who we have as guests on our show kind of have maybe a story, a why, something that burns in their belly that says, you know what, I decided that I'm going to swim upstream like a salmon and not do it like everybody else for a reason. Do you have a story that like drives you of why you get up every day barking from the fences?
No, man. So, for those who know me, have and understand that I want to disrupt and I want to not be the status quo. And for many, many years, I was swimming in the same lane of the status quo. And it's hard to distinguish yourself whenever you are amongst a crowd of everyone else. And my personality is more of an accountant. So I have a drier, much to the fact personality. And sometimes when you have that fact finding personality, you you are not with the standard insurance, very eccentric, very outgoing personalities. That's just not me. I'm a bland accountant, and that's the space that I like to be in.
I love it. I love it. And you actually come from the background of a medic, if I remember that correctly. Give us that story.
Oh boy. So I had ambitions to advance my medical career, to become a physician one day. And right out of high school, I went to paramedic training. And I was 18 years old. I was pushing morphine. I was intubating people. I was cardioverting people. And the running joke was I couldn't buy beer. So I was able to push the drugs that were to get people, pain relief, but I wasn't myself able to get any alcohol purchasing um, to my entertainment. So, but yeah, I was a paramedic for about 25 years.
Awesome. Awesome. So the subject du jour is one of, if not maybe the sexiest word in our business. And by sexy, I mean, it's thrown around in so many different capacities. It's thrown around as like a magic pill. I want to dig into that today and kind of debunk the mistruths and really leave the audience with some questions and some fact finding that they can go do to hopefully come to the conclusion that you did that like, hey, the solution that we're talking about here really is advantageous for a lot of people. And quite honestly, I think people are going to leave with an understanding that it's not
Mhm.
for the jumbo Coca-Colas of the world. This is for your everyday employers.
Yes, sir.
That word is captive. So let's just start with the 101. What is a captive?
So, in the very simplest terms, a captive is a private insurance company that is in contrast with a commercial, insurance company. And a commercial insurance company is regulated to sell insurance to the public. A captive, although it's still regulated by the same regulators who regulate a commercial insurance company, a captive can either issue a policy or reinsure a policy for its member or owners of that captive insurance company.
So if we think about this, trying to make comparisons, so groups that might be listening and advisors who are listening, you're fully insured. You're fully insured. I think everybody knows that. I'm buying something from a commercial insurance company where they have all of the risk. We move over to a insured, self-funded basis, and employers end up buying stop loss reinsurance, right? That protects them. How does this compare, contrast to that coverage that an employer is used to buying, that they might call stop loss or reinsurance on their side?
Really, essentially, it's no different. So with our model, which we'll get into, but our captive issues a stop loss policy that is the garden variety stop loss policy that is issued by a commercial carrier. It has the same words and has the same meanings as a commercial carrier, except it's written in a manner to really benefit the owner of the captive. So it still protects the insured, the business, against the frequency and severity of entering into a self-funded self-plan arrangement. So the cash flow risks associated with self-funding.
So I'm buying, either again, stop loss or in the captive. I am trying to protect myself, like a car insurance, hey, up to a deductible for those catastrophic things. Oh my gosh, if I have 17 cancers and 10 premature babies, I've got something that protects me from the catastrophic. And then over here, I have another one that protects my what I call sleep at night insurance. I know at the worst case scenario, I'm never going to pay more than this. So that happens in the self-funded world. That happens in this captive world as well.
No different. It easy peasy, man. Just it's protecting your cash flow against the shocks that can't be, discovered through the policy year. You're always going to get something that pops up, and that's what stop loss is for.
So in the normal world, I get a policy from, a commercial insurance company. And having done only self-funded my entire career, I also know that those are pretty profitable companies, right? So they've got sales reps, they've got buildings. Some of them are the most reputable and recognizable brands. In this captive, conversation, there does allow some of the appeal is that employer now gets in the game, right? Gets part of that. Talk us about the advantages of a captive.
Oh boy. So I'm going to give a shout out to Warren Buffett, who said, if you ever want to buy into a business that has a guaranteed return, almost, it's an insurance company. And that is what a captive does. It enables the insured who wants to participate in the attributes of an insurance company. I mean, let's face it, if a business thinks that they can run their risk more efficiently than the others within the marketplace, they want to buy into an insurance or a captive insurance arrangement because it enables them to reap the benefits of paying more premium and having less claims.
So, you said that in an eloquent way, right? I think of insurance as nothing more than gambling, right? We're betting on ponies, for all intents and purposes. You make good bets, you make bad bets, but at the end of the day, if you knew exactly what was happening, you wouldn't insure around it. It'd be a guaranteed thing, right? I got my degree in risk management insurance. The definition of insurance is to protect the unknown, right? That is the reason you have that financial product and financial, give and take. In that example, though, you said, hey, if I know that I am doing things that I'm going to beat the odds, then that's a great way of getting into this. Talk to me about, as you think of it and you see, hey, we're the end product over here, but there's commonalities around employers that are thinking about doing things. They are doing things, their mindset. When you think about the ideal client, both an employer client, let's go with them first as an audience. What do you think is the ideal situation or characteristics of a good client?
So I'm going to tie this conversation to one of my favorite movies, 21. And it was about the MIT guys breaking Las Vegas, right?
Yeah.
Awesome movie. I love that movie because I'm a numbers guy. So the what I'm trying to say is if you do your homework and you engage in the affairs of risk management, you start removing the veil of uncertainty. I promise you that if you engage and understand where your costs of risk are sourcing from, you can control those. And when you can control those, you can stand to generate underwriting profits in your captive insurance company. I mean, geez, that's the reason why you do this. You don't want to join a captive to just pay less insurance. You know, I'm a self motivation kind of guy. No employer ever said once, hey, let me join this captive so I can pay less insurance so I can subsidize that other guy. No, every employer makes a buying decision. Every CFO makes a buying decision based on what? What's in my best interest, said the CFO. So that's how we came about the change in our model to what it is today. So the takeaway is it's a participation sport. You invest the time, you will reap the benefit.
So I love this because I think it goes with a big theme that at least I observe in the industry is too many people don't pay any attention. Too many people, run their second or third largest expense almost as if they, let their kid go to the grocery store with the credit card. The kid's throwing everything in the checkout counter, right? In the
Yeah.
cart. They get up to the beep beep and they're throwing it out. And then they look at the end of the bill, they're like, wait, how is this $700? Well, what have you been doing all this time watching your kid throwing Fruit Loops and all of the other things on there? And I kind of liken the analogy that way. When you look at some of the, best performance that you've seen, what are the characteristics of that employer? So when you say, hey, it's a contact sport, it's a participation sport, it's something you got to pay attention to. What does that mean? Like, peel back that onion.
Yeah. So the common bond, I like to say, is that this is really a CFO conversation. When it comes to the greenbacks and the dollars that are involved in the cost of employee benefits, the decisions should start and end in the office of the CFO. So the common ground or the common bond within all of our clients is really to take their number two expense and if they can mitigate some of that expense, that's a good thing. But they're also generating assets within their captive. And that's one of the things that our model, different from group captives, you can generate real assets that can consolidate on your balance sheet. So this is really an opportunity for the CFO and in conjunction with the CEO to understand that they are investing in themselves by way of a captive insurance company. So every one of our clients, our captive owners, wants to do and make the decisions that are best for their company. They are not looking to subsidize third parties, even fellow third parties within a risk pool. Sometimes a group captive doesn't you know, allow for the self-interests to blossom as they should in a captive insurance arrangement.
So, in that example, I look at that very much like a team sport that, hey, I'll go with me. I was a baseball player, but I was a pitcher. I knew that if I brought my best game to the mound, the likelihood of us winning goes up. And if I didn't bring my best game to the mound, we were probably going to lose. But I still needed the shortstop to,
Yeah.
catch the ground balls and turn the double play. I needed the catcher. I needed the left fielder, right fielder. So in that scenario, like everybody still wants to play their best game, but everybody wants to get into a pool with other people who are also thinking, I am bringing my best game here. So you're creating the 1992 dream team. If we're going to, basketball analogy, it's a bunch of people who are looking out for others' best interest by looking out for their own best interest.
So the priority is this, and this is the way we structure our captive risk pool. If you're not motivated to actively engage in risk mitigation, which will you know, that that'll transpose into profits. If that's not your number one priority, then why should others want to subsidize your losses, right? You have to have a self-interest. Now, what we discovered in the group captive model is what I like to call the kumbaya approach. Everyone says, we're going to drive down the cost, we're going to, you know, do the things that control the risk, but there's no self motivation. And again, no CFO purchases insurance with the desire to subsidize those that don't engage in risk at the same way that they are.
Love it. So let's do two things. One, I would love to know, because you might have some people, it's like, wait a second. I've been buying insurance for my company for 20 years. No one's ever told me that I could actually do something to mitigate my risk, right? So, like, my carrier comes in and just tells me where my renewal increase is and shows me a couple of different options to bring it down. My advisor does the same thing. When you look at some of these employers who, again, motivated to do something about it, are doing something, what are those companies doing?
Oh boy, the list is long and complex. Okay, but it doesn't have to be complex because there are service providers that do that for you. The s- the the most important thing is that first step. So you have to identify where your spend is, and then there are service providers and consultants that can help steer that employer to solve the problems. And the problem is, where you bleeding from, right? Wi- If you give me the average employer and they have, $1 million to spend, I would probably suggest to you that 2 or 3 or 4% of those employees within a population are the main drivers. So you got to handhold those 2 to 4% of the population, and that will drive 80% of your claims. So you just have to identify where you're bleeding from, where you hemorrhaging costs, dollars from, and then you can deploy the service providers that your consultants generally have access to.
Theoretically, yes.
Yeah,
Um,
theoretically, yes.
let's I'm an employer. I am raising my hand. I want to journey down this. Okay. I've been self-funded. I'm starting to pull some of the levers. I, feel like I understand this game, and I'm continuously seeing that I am beating the averages by doing something. And now it's, hey, I'm getting to the point where I want to consider what is next, right? I'm keeping it. And so now I've heard this word captive, and I kind of have a couple of different decisions, because there's captives just because the word captive, not two captives are the same. So walk me through maybe some of the options, and then, let's kind of dig into what are some questions and things an audience member should think about when exploring those different types of captives.
Oh man, you're singing my praise right here. So here's what we're going to talk about. Within the world of captives, if the captive is only issuing one coverage line, and let's talk about medical stop loss, that captive is either a reinsurance captive or it direct writes the policy, medical stop loss. So for group captives are reinsuring generally a admitted carrier's insurance policy. So pick any commercial carrier. That commercial carrier is issuing the policy, their policy, to the insured business. And then the captive is reinsuring that carrier's policy. Now I can go into more on what that means later, but then the other type is the direct writer policy, where the client's captive is issuing the policy on the captive's paper. Okay. So the captive is a non-admitted carrier. That is perfectly fine. So the reason it's fine is, um, well, there's a whole laundry list of why a captive can issue a policy and why the insured doesn't need an admitted carrier. But nonetheless, either a reinsurance captive or a direct writer captive is really what's on the market today.
So if So let's go back to that group, word. That group word, I am joining a captive. There are other employers in there, and the sell is to me, hey, you've got a bunch of other people that are helping uh harmonize, renewal increases because some will win, some will lose, some will win, some will lose. But in that scenario, um I'm limited to the decisions that I can make because there's other people in there. Visibility is probably another thing. Talk to me about the characteristics of, hey, why might somebody like this versus not when we just think about the group captive world?
So I think if I'm a buyer, an employer looking at a captive solution, you really have to ask yourself a few important questions. Number one, what is the culture of that group captive? If the culture of that group captive is to drive down insurance premiums and to get more efficient and to identify, hey, we can deploy a policy at a less expensive cost than the commercial market. Okay, that's probably a good mission to have. But then you have to ask yourself, what's the care and feeding of that entity? AKA, what's the expense load? Because remember, when a group captive is reinsuring a commercial carrier, that commercial carrier has shareholders. They are most likely a publicly traded company. Those shareholders demand a return on their investment. So a group captive has their expense load. Not only is the insurance carrier, the stop loss carrier, generating a profit, but the captive has to generate a profit too. So you have to ask yourself a couple key, very important questions when considering a group captive. What we bring to the table, and we also do group captives, but our flagship are single parent captives. The single parent captive, we don't have a fronting carrier. So our expense load, I mean, I'm gonna, you know, conservatively say we're half the expense load of a group captive. And that translates into when the employer pays $1 into their own captive, more of that dollar is being available to pay claims. So,
So what might be, because I might hear that and say, okay, well, single parent, I'm the only one in there. Ooh, I'm scared because
yeah.
if I have one of those bad years, am I gonna be clobbered? Talk to me about because even in the way it's sometimes described, right? Group, you're insulating yourself from all of these bad things, blah, blah, blah. And over here, it kind of seems that what's the reality of what happens behind with the mechanisms and how people do share in that risk pool?
So it's called risk pooling. So we have what's called a risk pool. And the risk pool, think of it like, the four walls of a hotel. And then every employer has a hotel room, which is a single parent captive. So in our model, the risk pool is where the shifting and sharing happen, which is the financial leverage. So you just said it, solvency. If I pay 100,000 of premium into my captive and I have 200,000 of claims, well, now what? Well, the risk sharing and distribution happens in the risk pool. And in that case, your captive is not profitable, but your peers, your other single parent captives, are picking up your losses.
In that same exact example, 100 and 200, what happens in a group captive to kind of compare and contrast?
Well, that's a really good question because sometimes that's opaque. Within a group captive, think of it like this. There are two risk sharing allocation models, really. Everyone pays premium into the pool. And then if claims are incurred, those claims are paid from the pool. So if the pool has $1 million left over, that's the profit. How is that profit allocated back to the other participants within the group captive? So, in other words, you may have what we call a taker getting back profits from other people. So, in other words, if I'm a contributor to the profits in a group captive's risk pool, I want to maximize my profit taking. I don't want my profits diluted down and my profits giving to an insured that effectively paid 100, took 200 out. So the risk pooling modeling really needs to be explored by, a captive insurance expert to understand what that looks like. Now, some group captives have, if you pay 100 and you take 200 out, well, you get nothing of the underwriting profits within the group. And we subscribe to that because if you're trying to generate underwriting profits, you want people to be profit motivated, period.
So in that example, you still want the same mentality no matter which way you're going. Now the question really becomes, are you protected if you were on the wrong side of that 100 and 200, example?
That's right.
But you still want, when you paid in 100 and you only spent 30, that's also want the lion to still eat the lion's share.
That's right. And, as Gordon Gekko once said, greed is good, right? You want people to be motivated for profit taking. Insurance companies generate profit. There is nothing wrong with you saying, I'm going to go full throttle to control my costs. I want some type of return on investment. It's that simple.
If we had to say the downside of a single parent captive, or what might be perceived as a downside, what would you normally say there?
Well, the market has perceived single parent captives as only an option for jumbo employers, 1,000 plus employers. We don't have that. So the value really starts if you have 100 employees or above.
Okay.
Within our risk pool, we have got captives that have 50 employees, all the way up to several thousand employees. So we serve the gamut on the range. The the downside is you need to be a participant. You're not going to be able to just write a check and forget it. You bought an insurance company, right? You're not going to buy a gas station at the corner of the road and give your employees half price gas. You need to make this an investment that is to your benefit. You're running an insurance company now, and a group captive that is sort of watered down, right? There's not that you don't have the same effect as if you owned a single parent captive.
So you brought up an interesting point that I think a lot of people probably have a misconception on. So, and I know that I did. Single parent, sounds like it is a big employer. So you've got groups that are down, 100-ish. So let's just call it $1 million of premium in those scenarios. Um, the automatic rebuttal would be, oh my gosh, that's a volatile group, right? That is a group that has one bad claim and they're upside down. When you look across your risk pool, is there any correlation to the thought process of, hey, that small companies typically eating at the profits of everybody else's, or have you seen it where it is truly balanced? And what's been the experience there?
Our experience has been rock star experience over the past. We we were once a group captive. We were a group reinsurance captive. Our members didn't have the same controls that they desired to have when they subscribed to this captive program. So from 2016 until today, we're deploying this model, the single parent captive within a risk pool model. And today, our expense load is a little bit less than 15%. The garden variety group captive has an expense load of 30, 35, 40 something percent. So to take that one step further, for every dollar that we bring into our single parent captive ecosystem, we have 85 cents on the dollar to pay claims. Let's fast forward 12 months. On average, Lester, on average, we have given back 35% of premium. So not only are our members paying market share, market equivalent stop loss premiums, because we have such a low expense load, we're giving back a lot more money at the return of premium. And on average, that has been 35% per year since 2016.
So I'm going to come back to that because I don't want to forget something that you said that I wrote down. You said that the conversion from a group over to the single parent is largely driven to the members desiring more control. If we were going to educate the audience of what that word control means and maybe what questions to ask when doing the evaluation of where they might think that they want to end up, when you say that word control, what do you mean? And what are some questions that stir around there?
So one of the things, so control to us is the governing documents, who controls the words on the page. Okay. If within a group captive, the medical stop loss policy that is issued to the insureds is written by the stop loss carrier. They are using, make no mistake, they are using words in a manner that are favorable to them. And rightfully so, because they're shareholder owned. Okay. The reinsurance agreement is also written by the stop loss carrier. So the two controlling documents on how claims are paid, how they are reinsured, everything is written by a third party. So if you join a group captive, you have to subscribe to language that is written by someone that is not aligned with your benefit. Number one. Okay.
Mm.
Number two, whenever you have a claims clash, the winner of that clash is always going to be the payer, right? The stop loss carrier is the payer of claims. So in a group captive, it operates on what's called a funds withheld basis. So that's equivalent to, I'm going to ask you to buy me a refrigerator and I'm going to give you my checkbook. You're going to go to Home Depot or Lowe's or wherever, and you're going to buy a refrigerator using my money. Well, that's the same way with a group captive. The carrier is holding your dollars and paying your claims with your dollars. When you buy a commercial stop loss carrier, you're giving that carrier your dollars, but then they're paying claims with their dollars. Not many people understand that.
Mm.
Okay. So the control is with a single parent captive, you are paying your captive. The policy language is written to benefit only one person, its owner, and you're paying claims, you're reimbursing yourself for those claims. So there's never ever a clash with claims.
Interesting. So, that is a version of what we talk about every day calling misaligned incentives. The reality of it is, if you're holding dollars that we all call premium, and that same bucket is used to pay claims, you're not likely loving the fact that you're writing a check out of your bank account to appease that. So is technically then in a group captive, the owner of that group captive are not its members, or how does that technicality work?
Well, boy, so if this is where you said it earlier, if you've seen one group captive, or if you've seen one captive, you've seen one captive, and ownership is a big part of that. So many times there's window dressing on ownership. So a captive manager will say, Lester, you own the captive. But me as the captive manager, we have an evergreen contract, which means you can never fire me. So independence is important. I'm the captive manager for a single parent captive ecosystem. Even though I started that captive with my own assets, I had no equity position. I am now just a service provider. I could be terminated by the board of directors. So you have to ask the questions that are, I may have ownership, but do I have control? That's an important question. So sometimes you have group captives that are owned by the actual commercial insurance company, which, to me, that it may be a good investment or a good model, but you're never going to have the controls. And if you want control, you're not going to get it there.
Yeah. Yeah. And, some of these group captives are very popular, very big, billions of dollars. So if we're kind of on a spectrum. The worst scenario is staying fully insured, right? Then as we get from fully insured and we move our way down, so would we describe it as it's better than just paying for a normal stop loss policy? So it's a step in the right direction. However, when we use those words ownership and control, the top of the mountain for both of those words is a single parent captive.
Yeah, so we like to take the stance that we lived on both sides of the fence. So our captive was a group captive reinsurance model. We had less control. The next iteration of it is what we graduated into is the single parent captive. So now our clients own a captive insurance company outright. They are paying premiums to themselves. This is literally left pocket, right pocket. And for my CPA friends out there, what happens when you own 100% of a sub? By golly, you get to consolidate. Okay. So that is alone one of the most important things that it differentiates a group captive where no one's going to own 51% or more to an insurance company, a captive that you own 100% of. Control and ownership is not only the thing, it's everything.
Got it. So let's make this real. Talk to me about two clients. Talk to me about the smaller end of it, and then talk to me about the bigger end of it. And it just so happens, coincidentally, we booked this weeks ago, but we were together last week. So I got to see the spreadsheet of like how things are performing. But talk to me about somebody small and talk to me about somebody big. And I might interject some questions there just to add some clarity.
Yep. So, middle America, I'll say the state Tennessee, okay? A manufacturer came into our captive structure at the peak of COVID, 2020. And at the time, we didn't know if the world was going to end or not. But at the time, he made that investment. And it has been remarkably good. And the reason it's been good is not because of his claims experience. Believe it or not, he didn't have stellar claims experience. Okay. And that's okay. But what he did understand is where is he bleeding from and how can he fix it? And yes, he invested his time to fix that. Okay. Now he's on a good path. So he has generated underwriting profits in his captive since 2020 that are about 30 to 35% of what he paid in since 2020.
So
Okay.
so let's take that. Hey, I didn't necessarily knock it out of the park.
Yep.
I got to dig in the mud. I played in the mud. I did something to protect it. And aggregately over this, even though I didn't start off, out of the gate sprinting the hardest that I could, essentially 30 to 35 cents on the dollar that was paid in has now generated a profit for himself, not for
That's it.
everybody, for himself.
Him. And he is now so much involved that we have committees within our captive structure, and he is now a committee member. So not only is he satisfied with his own performance, he wants to influence the entire committee and system wide, which is fantastic.
So Phil, would you say is that person a C-suite individual within their organization?
He's the CEO, yes.
The CEO. So I'm a CEO, you're a CEO. We got a lot on our plate, or you're a COO, but same thing. We're running businesses. We've got things going on. This is because this is often something that I'm just going to say it pisses me off when I see organizations not spend time on this and it's like an afterthought. So this is somebody who maybe didn't come into this spending as much time, saw the potential value, reallocated his personal time into spending more time. And not only has it generated a benefit for his organization, I'm sure that's now trickled down. Do you have any sense of how that's trickled down to the employees that he employs? Because I'm assuming if they've had decent participation or decent experience, that has meant, not huge rate increases for their underlining plan. And if that happens, employees' plan designs are good. Talk to me about, is there a correlation there?
Absolutely. So it's all tone at the top. Every executive has to set the tone. Okay. It's that simple. If leadership does not have buy-in, the rank and file, the staff members who are the utilizers, they're not going to buy in. So why would I promote something that you should do, Lester, that I'm not willing to do myself? So yes, there is a list of items that he actually engaged in, which ultimately saved money. But I'm not at that organization, but he's still in there. He doesn't have high employee turnover, so he must be doing something right.
And again, when people don't understand, I want to make this, known, controlling health insurance claims how many and how big impact what we pay for insurance. And so, in this correlation with this person, let's say he's a business owner, this is left pocket, right pocket for him too, right? Hey, the better I manage my healthcare, my second largest expense, assuming none of my employees want to pay decrease, this is the number one item that can be impacted to generate mutually beneficial outcomes, which is employer, him. Literally, I generated $1 million of savings. I technically could put more money down to the bottom line and I could take out distributions from the company, and that's good. But then, as we think about it from an employee centric standpoint, employees understand that their direct decisions of where and how they access healthcare influence how much they pay. So that mutual alignment of their incentives is one of the, back to your point, control and ownership. When I can control something, when I can own it, and I teach everybody around. So do you find that employer or most of your employers are having big boy, big girl conversations with their employees, that they understand how money flows and how money works, so that people understand their decisions are impacting this?
So you witnessed this last week, and you know the employers who are engaged, they will have the realistic conversation that says to their staff, look, as a business owner, we can either pay that hospital down the street or that drug manufacturer all of our money, or we can keep it inside and I will distribute it to you. Which one would you like, Mr. Employee or Mrs. Employee? I want to keep you happy. So I want to pay you and I want to reward you, time off, whatever. So we can either pay them or we can either pay you. Which would you like? And that is a realistic, because employees don't know what healthcare costs.
Right.
Okay. When they see a drug on TV, they don't know it's $18,000 a month. They just don't know it. Okay. But they're solicited as a cure. It solves this, it helps that. Of course. So
Yeah. And those two things might be true. It still doesn't negate that it's $18,000 a month, right?
that's right.
It's just the deal. All right, so we talked about the smaller end. What about a larger employer?
Man, so the one that I can think of, the consultant, he's very one of our top
We can give him
performers.
props. We can give him props. That's fine.
All right, you want me to say his name? I'll say his
Yeah,
name.
he'll like this.
Spencer Allen, buddy, I love you to death.
All right.
So one of Spencer's larger clients is in our captive, and I jokingly say captives are generally more challenging to, you know, to sell. We don't sell captives, but we got to explain it. All right. To this day, he was the easiest group that we ever closed, because Spencer said, well, Phil, I told him this was the best solution. I vetted out other captives. What did you expect? So it was a joking aha moment. But w- this employer was paying, a million, 1.2 million of stop loss premium to a carrier. And in their captive, they've been in it for 2.5 years now. They have an excess of $1.5 million of underwriting profits in their captive. So 3 years ago, They were expensing $1.2 million. Today, they have 1.3 or so, 1.5 million sitting in their captive.
While still spending over here in the company, it's still an expense, but
That's
over
right.
it's sitting as an asset in the balance sheet on something
Yes.
that they own 100% of.
Yes, they literally they picked up $1 million off the floor and they put it in their pocket. It doesn't get any sweeter than that. And not only are we, doing that for our clients, but we give them unaudited financial statements every quarter. So not only are they achieving it, but they're seeing it too. It's the market.
And the visibility of seeing what is happening and performing everywhere. So they not only
Yes.
see what's happening in their little pool, they see what's happening everywhere.
Yes, it's wonderful.
So in the point that I wanted to make that was an aha moment just now that I had is this isn't asking anybody to pay money that they're not already paying today. Which is it's quite of an interesting thing because, I have heard a lot of people when we think about collateral and like, what is the startup cost of being in this insurance company? And the mutual client now that we have, I mean, I put it as a line item. So like a line item was this is the amount of money that you were putting in to start your own insurance company, just like you would to lay down to buy your own house or you start a company, you needed a first dollar to fund the company. So there is nothing that you generate an asset, class that you don't invest to start that asset. So it completely makes sense. But that's their dollars. It is a line item that was used. And in this scenario for our mutual client, all in all, it was still cheaper than right in line with what the rest of the market was gonna be. So, I mean, like, literally, we sat around the table saying, "If we're gonna pay this dollar, shouldn't we just pay it to ourselves?" Like, that was literally the conversation.
Well, so one you struck a chord is within group captives, there's what's called collateral, right? And many people don't know that it's the fronting carrier that charges this collateral. And collateral is not a deductible expense, meaning I, I'm literally giving $100 of collateral from my pocket to you, Lester, as the fronting carrier. I can't deduct that $100. So I'm paying income tax on that $100 that I don't even have in my pocket. So collateral absolutely unequivocally sucks. I'm not going to mince words. With us, the client is actually capitalizing their captive.
Mm.
And capital is the investment basis into your captive insurance company. So even though you're not deducting the capital from your P&L, you're picking that capital up as equity when you consolidate your balance sheets. So it's left pocket, right pocket.
Love it. Love it. Well, Phil, I am sure that we could spend 18 more hours having this conversation. And I'm sure that we have sparked some things in people's mind. If somebody was listening to this and says, I got to hear more, I got to see what this looks like for me. Where can somebody, get a hold of you, understand this more? Where do they learn more? How do we get people to be more knowledgeable in this space?
So you can contact me by going to our website, which is completecaptive.com. I'm on LinkedIn, Phil Holowka. I'll let you guess how to spell my last name.
Well, we'll have
Keep,
it in the show notes, so don't worry.
keeping guessing.
Yeah.
Just give me a call. I mean, I'm happy to walk you through it and give you, the differentiators between what we call the next iteration of medical stop loss captives.
Phil, I appreciate the explanations on this, and again, seeing it with my own two eyes as somebody who is an educated person in this space was enlightening to the interactions between truly having this asset over here, and we'll leave everybody with if we understand that we're going to spend the dollar. And we understand that insurance companies are some of the most profitable and wealthy organizations. We should marry those two things together and say, if we're going to have to pay for it, we might as well pay for it in a way that actually could benefit us. And in the middle, that bridge that makes me so excited is there are so many other levers that client can invest doing that, they're reaping the rewards on the claim side, but they're also reaping the rewards in underwriting profit that they would never get if they weren't in this space. So it just aligns everybody's incentives just truly from the beginning.
I love the space that I'm in. Even though I loved EMS when I was a young man, EMS is not a young man's game. So, but I love what I do every single day.
Love it. Love it. Phil, thank you so much for being on. And if you heard this and you're already self-funded, this is kind of the next thing that you need to consider. But at the end of the day, everybody needs to take, and I'm going to theme this one out. We talked about captives, but what I want to make sure that everybody draws and leaves the correlation. That is, if you control your claims, good things happen all the way around. So focus in on the claims and everything works kind of its way out. Phil, thanks again to our audience. Thank you so much for tuning in. Make sure if you like this that you're sharing it with people, because this is the way we get more people aligned to take more time into their second largest expense. And when that happens, communities get impacted, employees get impacted, and we truly do impact healthcare. Thanks so much for listening.
You've been listening to Impact Healthcare, people and strategies that are disrupting the health benefits industry with Lester Morales. Remember, the journey to getting 20% savings on your healthcare benefits starts with total transparency. Remember to subscribe to the Impact Healthcare podcast on iTunes or wherever you get your podcasts.